So debt on a quality growth asset isn't automatically bad. It's the cash flow structure of it, the loan-term management that you might have left. You might have switched over to principal and interest. I've certainly learned the hard way when I look back at being super active and super busy. But if I'd just held onto some of the properties that I had, I would have been far better off. There's no single Perth market. There are hundreds of micro markets, hundreds of suburbs within this overall Perth market.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and today I'm going into one of the questions that I get asked on a daily basis. Should I sell my investment property and is it the right time? So Perth's booming, as you know. We've had really strong growth. Stock levels are super tight still, and investors are sitting on some significant equity, which is wonderful for all those that have been through some of the more quieter times in the past. They've now been rewarded for that patience. And now there's additional noise around potential capital gains tax changes. So I unpacked that back in episode 271. There's some rumours that it may not likely be going through. We'll have to see how it all shakes out. But whenever tax reform gets mentioned, fear creeps into the market and into the questions that we're asking ourselves. So people start asking, should I sell before something changes? Should I lock in my gains? Have we hit the top? And here's the truth. That's the wrong questions most of the time, because property isn't like shares. You don't click a button and exit. You don't move in and out of property without significant consequences. It's a lumpy, chunky asset that you can't just go and sell little parts of it off. So that is some of the benefits of shares and why it's nice to have a mix of things in your portfolio. When it comes to property, every time you transact, you give away years of compounding through costs and friction. So instead of asking, is now the top, you should be asking, does selling move you closer to your long-term strategy and the goals that you're actually trying to hit? So today I'm going to walk you through 4 filters that you should apply before you ever list a property for sale. Now, the first one is your situation, then going through your strategy, then taking a look at the market and your tenancy, if you've got one in place. And all of these would apply in the first 3. You can put that overlay on your home situation as well. So it's not all about your investment property, but I'm going to focus it on the investment today. So if those 4 aren't aligned, selling can become one of the most expensive decisions you make, especially if you look back and wish you hadn't done it. So let's break it down, shall we? Let's take a look at your situation, and do you actually have a solid reason to sell? So think about your personal situation, because sometimes selling isn't absolutely the right move, but it needs to be deliberate and not reactive. I hear from landlords that have a little bit of trouble with a tenancy or have some costs come up, they consider selling. If many of them did that 2-3 years ago, they would have missed out on all that upside. So I'm glad I talked a lot of people out of it over that time. The first question I often ask is, why are you looking at it? What are you looking to do with your situation? So some of the more deliberate reasons to sell would be to upgrade your principal place of residence. I mean, it's a great time to consider taking gains on your investments, upgrading into the next higher price point that's still relatively undervalued compared to the lower end. And if selling an investment allows you to upgrade your family home or reduce non-deductible debt, improve your lifestyle, reduce personal financial pressure, then it can make sense. And reducing that non-deductible debt is powerful, but I really think you should think about it in terms of your overall stage of life and how that fits into your strategy, which is going to be our next point, which we'll go into. So lifestyle decisions are strategic decisions, and that's not timing the market, that's life planning. And so it doesn't matter as much about getting that timing perfect if you're going to sell and buy in the same market. Although there is opportunity to be had from selling in the bottom end that's already grown a lot and moving into the middle. And I've been talking about that for the last 18 months or so. And one of the other great reasons to look at selling an investment property is that you're downsizing or your life stage is shifting, and you want to bring money in and change over to different assets. So if you're moving towards that retirement goal, simplifying your holdings or restructuring risk, that's valid too, because it could make a big deal if your time horizon's short for when you're thinking of selling, whether it be a year or two, and that's on the horizon. Sometimes it's worth just de-risking and taking some chips off the table when you know that the market's hot, and not necessarily waiting until you squeeze every last drop out of the lemon, because it's so hard to do that and so hard to choose that top point. And we don't always know it until we start seeing it trend back the other way. But again, that's strategy and not emotion. Some of the other reasons to think of selling is that the asset's inferior. This is one of the strongest reasons to sell. I think a lot of people have bought inferior assets, and this was very much my journey. I started out buying what I could afford, didn't necessarily know how to do the research properly, didn't have a methodology for how I purchased. It was all going well when the market was going up, but didn't have the staying power. So I decided to get out of assets that when I look back on, I wouldn't have bought again today. So I've exited over time. So that can be a real good move to get out when the market's hot. Like when you're on a busy road, we go and try and sell that. When the market cools off, it's going to be a lot harder to sell when we've got a super hot market and buyers still competing for that type of property just so they can get in. So if I didn't own this property today, would I buy it again is a great question to ask. And if the answer is no, then that's a serious signal to look deeper. And inferior assets often look like having really high and out of control strata fees, a low land component that hasn't had the most. If you haven't had good growth over the last few years and you look back, you'd know if history shows that it hasn't performed. If the location's really compromised, like I just mentioned, being on the busy road, if you're in an oversupplied apartment sort of market, that's definitely worth considering. If you've had a lot of trouble finding tenants and there's weak rental demand, that's another thing that's only going to get worse. If you're having trouble now and having trouble with any of these things now, just think through to if the market softens, both on the rental or the sale side, how much more difficult it could be. And that could be a good signal to look at selling when things are still hot. So what you're trying to move towards is better quality, and upgrading your portfolio quality can be a very good strategic move. The other factor that people often don't think about is concentration risk. So if most of your portfolio is all concentrated in one suburb or one price bracket or one employment driver, then you may be overexposed. And that may not be such an issue when you're starting out because you've got time for these things to correct. But again, when you're getting a bit older, you might want to rebalance things. It can make sense. So but only if you're moving into something strategically stronger and your overall portfolio is benefiting from doing that. So you don't want to just be reacting to noise. Now, one of the other good reasons is, well, on the face of it, people say, I want to reduce debt. And there's a lot of this sort of going on with people that have gained a lot of equity. And this one really does require deeper thinking. So we're in a super high inflation environment. The real inflation is much, much higher than what the consumer price index indicates. So inflation is great for eroding debt over time. So it's healthy to actually have some level of debt that with over the top of assets that are going to hold their value. Rents will continue to increase. Asset values are going to continue to hold their own or increase, and the loan stays the same and nominal. And that's how inflation works away at reducing the real world value of that debt that stays at the same level. So debt on a quality growth asset isn't automatically bad. Often the problem isn't debt itself. It's the cash flow structure of it, the loan term management that you might have left. You might have switched over to principal and interest, so that could be an issue. I'd look at the interest rate and make sure that that's on point. Look at overall strategic planning And it's not necessarily, don't just jump straight to clearing the debt. So selling to reduce good debt can be like cutting down a fruit tree because you don't like paying for the water. And before you go and sell, I would ask the question, is the debt the problem or is the structure the problem? And if you're still early in your journey or even mid, I wouldn't necessarily go removing all your debt. I know it feels good for that moment, and I've helped a few people do it lately, but it can be a bit hollow. And if you have to go and pay transaction costs to get back in again, to get an asset again, like, would you have just been better off holding it? Now, some of the exceptions to this can be when your debt's in the wrong places. So you might have really high debt against your home, but very low debt against your investment properties. That's where it can be worth chatting to your financial planner, seeing whether it's worth recycling it across to paying down your home and then withdrawing it back out again to buy an investment. And that's where if you've got some of the above factors also at play, like doing that at the same time as upgrading your home or at the same time as selling out of an inferior asset or helping some of that concentration risk that you might have, or at the same time as downsizing, for instance. So I like to think of having a combination of reasons really strengthens that decision to sell. Now, you may have heard me speak previously about numbers and returns and just how this stacks up about holding for the long term versus trying to trade in and out of cycles or sell in and out of cycles. So this is where most investors underestimate the true cost of movement and changing over properties. Property is definitely not frictionless. When you sell and buy again, you're paying agent fees, you're paying marketing, you're paying possible staging, settlement costs, you're paying the big one, which is capital gains tax. And if they ever mess with that, then the cost of changeover is going to be even greater. You're paying stamp duty on the next purchase. It all adds up to a lot. And that's where I've modeled things out. So if we assume a long-term growth rate of 5% per annum compounding, which is a reasonable return that to get over time, simply from a buy and hold strategy. And that becomes your baseline buy and hold return. But if instead you sell and reposition every 4 years and incur those transaction costs each time, to simply match that steady 5% compounding return, you'd need roughly 13% growth over each 4-year cycle. That's not to outperform the 5%. That's not to get ahead of the 5% buy and hold. That's just to equal it. So that's about 2.5 times the annual growth rate of long-term buy and hold, and you have to get it consistently. So finding those assets that are going to grow at 13% consistently over 4-year bursts and multiple cycles in a row, keep in mind, that's not just getting it right for one cycle, that's getting it right every time. And it's extremely difficult, and it certainly carries a lot more risk. So on top of that, you're layering in timing risk, market cycle risk, execution risk every time, emotional biases. So when someone says, I'll just sell and buy something better, the real question is, if you're going to keep doing this every 4 years, are you going to be able to go and get 2.5 times the return to pay for that movement? Otherwise, if you're just doing it once because you're in an inferior asset, or you're just doing it for some of those other reasons I've mentioned earlier, then that's where it's worth considering, but not to try to do this every cycle. When you crunch the numbers, you're not going to come out better off in most cases.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
Now, let's look at the strategic planning question. I like to ask this for each property, and it can help you get really clear on what its place is. So what's the property's job, basically? Is it a growth engine and you're trying to have it really add growth to the portfolio? Is it a higher yield, so it's giving you that, cash flow to even things out? Is it a stepping stone? So helps you get that family home, helps you stepping stone into better investment properties? Or is this a legacy hold where you're buying it forever? It's in a prime spot. You don't have any major negatives that are going to impact the growth of the property. So if it's doing its job, why would you sell it? Wealth is built through clarity, not through activity. And that's the hardest thing for us as investors, because it can be a bit boring sometimes, can't it? To sit on our hands. We have to, be patient. I've certainly learned the hard way when I look back at being super active and super busy. But if I'd just held onto some of the properties that I had, I would have been far better off. So now let's take a look at the third area to consider when deciding whether to sell. Let's take a look at the market. So the biggest thing to note here is that there's markets within markets, and that's going to especially start to become more the case as we enter this next phase of our growth cycle. So let's zoom out and look at Perth. At the macro level, we still likely have 12 to 24 months of solid growth potential. Why? Because we've got constrained housing supply, we've got strong migration still, we've got a very tight rental market, we've got construction bottlenecks, we've got low listing levels. But here's the key. There's no single Perth market. There are hundreds of micro markets, hundreds of suburbs within this overall Perth market. And then you've got the property types within those suburbs. So let's just talk about some of the segments and how that might influence your decision to potentially, again, consider selling along with the other things we've discussed. So the sub 850 house segment, where a lot of investors own property, is the segment that has been fascinating because first, investors drove that demand aggressively and we had supercharged growth in that price segment. And then first home buyers entered strongly, supported by financing incentives. And that has just poured extra fuel on this price point. It's effectively pulled the future demand forward from the first home buyers, especially. And when demand gets pulled forward, sometimes that means that future growth is going to moderate. Not necessarily a crash. I don't think we're not going to go through a boom and crash cycle like we did in 2016 to 19, but slower growth in pockets, especially those that are overheated. And if you own in that segment, I would be asking yourself, are listings starting to increase? Are days on market rising? Is urgency fading? And is new supply entering the pipeline? And that can get you clear on how your micro market is performing. And that's really important to look at. And that's what I consider when I'm chatting to a client about their overall strategy. So selling because Perth feels high is an emotional call. But selling because your specific micro market is peaking and you have a superior strategy for redeploying that, well, that's really strategic and it's data over headlines. So that's what you want to be doing. Now, the final part to this is if you're getting green lights to the above things, you've got a really good reason to. The market's sort of indicating that now it makes sense. You've considered your strategy and ideally it's part of your overall strategic plan. Then you can go deeper and look at your tenancy because people often forget this. Re-sign their tenant for 12 months, pop up a month later into that new 12-month tenancy. Oh, I want to sell and I want it done now. And of course, a tenancy lease stands and regardless of any sale. So that's going to prevent home buyers being able to look at purchasing the property. That said, I've had many home buyers. I've sold 4 properties lately that had long leases, longer than 6 months left. And they all sold to home buyers, so they're prepared to wait longer than they ever have. But we're still going to cut home buyers out of that mix and limit the demand and competition that's going to push the price up. By my estimate, and from what I've seen, it usually affects the price by 5 to 10% and could be more. So lease timing really matters. Let's talk about execution around this. So selling with a long fixed lease or poor presentation or unmotivated tenants can shrink your buyer pool massively, especially in family home price brackets where owner-occupiers pay premiums and they're the ones that are really driving prices. So I would consider offering the tenant an early vacate incentives. So sometimes you don't actually have to put dollars to this. You can just say, look, we plan to sell at the end of the lease. We're giving you the option to move out earlier with as little as either 2 or 3 weeks notice. If it's within a 6-month window, most tenants will start looking straight away. They'll often find something, they'll be able to move out. They can look over a longer period, so it benefits them. They don't have to wait until the end. They don't have the chance of double rent to pay, and they often appreciate that heads up and being given the extra time. So that's how we often handle things. But then if you want to ramp up the incentive, you can offer to pay them $1,000 to $2,000 to contribute towards their moving cost. And that just helps. You can put an end date on that. So if you are able to move out over the next 2 months or over the next month, then you will receive this compensation on vacant possession. So it's far cheaper to contribute that $1,000 to $2,000 than it is to lose, 30, 40, 80 grand because of either poor presentation and or limiting your market to mainly investors when you've got a long lease end date. Now, you can appreciate that many tenants are reluctant at the moment to still move. If they're building a house and they've got 4 months to go on their house build, or if they really love living there and they've set their sights on staying there, they can be very reluctant to move. So it's completely their choice. You can't force them. The lease can stand. And that's why it definitely helps if we're choosing very carefully what our plans are before we go renewing a lease. And if you're ever uncertain about what those plans are beyond a certain time horizon, you could look to renew the lease for 6 months at a time, which is what we do all the time with our landlords that are weighing up. It's a lot easier to see 6 months ahead about potential risks on the horizon than it is to see a year ahead. So we review every 6 months and decide what we're doing. So the other option to consider once you can come to an agreement with the tenants or you've waited until they've moved out is vacating the property and staging it. So this really gets us in the place where we're driving prices emotionally. We're selling the lifestyle and not just the shell. About 80% of my sellers do this at the moment just because staging produces the greatest return of any kind of presentation item. I believe it produces at least a 5 times return, sometimes 10 times return or more. And it drives that owner-occupier appeal, particularly I find it works across all price points, all property types. If your property's dated or small, it works even better because it takes people's attention away from some of the negatives. And if it's a higher end property, people's expectations are much higher. So you really need to do it just to be on the shopping list. If you're in a lower end property and you do it, people's expectations are lower. So you can get them a lot more excited and have them competing for it. So I really love staging, and unfortunately that does mean that the tenants need to move in especially if they're not presenting well and they're going to hurt the overall price. If there's some of our tenants, we can move them around to our other properties and help them with finding something else. And especially if you're giving them some flexibility on when they can move, that's a big help for them as well. And it's just about managing the whole process with respect and care and understanding that it sucks to move, but you've also got to consider your situation. And when you make the decision to sell, you really need to look at how do we do it for the best possible price and get the most out of it for you to move forward with and make those dreams happen. So I guess how to think about that, even though it's never nice to end a tenancy and have tenants have to move. So the other thing to consider is timing your lease expiry strategically, especially when we know that we need to sell. So very often we might write that lease end date to being 7 months away or 8 months away just to time us for early in the spring market or into the autumn market, not have it expire in January necessarily or December. We don't write leases to ever expire in December anyway. And if we've got other things on the horizon, we can strategically set that lease end date, again, to tie in with your situation and your decision points. And strategy always beats urgency. So definitely worth considering that whenever your lease comes up. Now, should you try to time the market? Here's my position on this. Timing the market perfectly is luck because think about it. Even now, the market's gone on way longer than a lot of people thought, including myself. And what you can control is how you choose to structure your portfolio strategically. That's a skill. But most wealth is built through actual time in the market, giving your properties a chance to compound, trying to choose those quality assets in the first place so that you don't have to sell them and change them over later, ideally. Controlling your leverage so that it doesn't consume you and you still get a lifestyle and you're not left needing to sell for any kind of financial reasons. And strategic upgrades, it makes sense when you're upgrading your home and taking advantage of that arbitrage. That's not a reactive exit. So that helps build wealth as well. Now, the 5 questions I would suggest you ask to sort of bring this all together before you go down the road of selling is, do I have a compelling reason, a personal reason to sell? Does this align with your 10-year strategy, and have you actually thought about how this all fits together and maps out? Will the new asset perform at a higher rate? And if you're going to plan on changing over every 4 years, is it going to perform at 2.5 times as much? If you're not going to change it over as much, you don't need as high a performance difference. But the more you change over, the harder it is to outdo that. And I like to think, the other question I like here is, am I acting on data or is this on fear? And finally, number 5 in my questions asked before you sell, is this asset fundamentally inferior? So if you can't answer these questions clearly, I would pause, I would think further about it, because selling well is strategic and selling emotionally is often expensive. So the goal, I think, shouldn't be to sell at the top. The goal is to build a portfolio you never feel pressured to sell, because when you have the right assets, the right structure behind it, the right strategy, and a 10-year plus roadmap, ideally out to 20 and 30 years, you don't react to headlines, you don't panic over tax speculation, you don't try to pick the peaks, you execute a plan. And if you're listening to this and thinking, I'm not actually sure whether I should sell or hold, that's exactly when you need clarity, not urgency. And before you go making any of these decisions, you should have a bit of a portfolio review, a strategic forecast. We can chat through these things. I can be your bouncing board. I would look at a clear understanding of your changeover costs. You speak to your accountant, you look at your capital gains tax that you'd need to pay. Is that going to actually give you in hand enough money after all of this to make that next opportunity or dream or plan work? And if a redeployment plan is in place, then you really want to know what you're going to do with it after you sell too. Because selling without a reinvestment strategy, in my view, is just shrinking your balance sheet. And there can be a lot of emotional reasons to sell too, but I think you need to keep it strategic. And if you want a proper data-driven answer tailored to your situation, not generic advice, that's what I do. So get in touch. I'm happy to be your bouncing board. We can either model it out or we can just go high level first and see how deep we need to go. Make sure it aligns with your long-term plan. No pressure, no emotional selling, it's just strategy, because timing the market is uncertain, and hopefully you've got that out of today. It's really hard to choose that top of the market, but structuring your future, that doesn't have to be, and that's where you can have clarity and apply it to this uncertain world. So hopefully you've enjoyed today's episode. Reach out if I can help with any of your property plans. If you have enjoyed it, I'd love to see any of your comments or questions and post a review. I really appreciate you tuning in, and catch you on the next one. Bye.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.